Okay, all right. Morning, everyone. Welcome back to our morning kappa at 8. Joseph here. So looking at the Hang Seng, right, in this final week of December, you can see that the Hang Seng Index continue to move on a higher high fashions, about to cross above the 50 days moving average. So you can see that for the past, I think about 2 months, right? The Hang Seng has been trading below this 50 days moving average. So if today it can cross above this 50 days moving average, it will be a very meaningful just before Hang Seng close for the year end. So right now on the upside, 26,500 will be the immediate resistance. On the downside, will be the 25,000 point, which is the support level, right? Just to recap that somewhere between this 26,000 point, right, in the late October, right? That's where the Xi Jinping have met Trump, and they have achieved strike a few deals, such as they have delay the trades talk for another 1 year, and China have promised to buy more soybean from the US, and in return, the US also extend the olive branch that Trump have suggest that the US will be able to export the H200 chips from NVIDIA to China, right? So despite all this good news, what we do see is that right now Hang Seng is trading below the 26,000 point. Clearly that Hong Kong market right now is undergoing consolidations, especially on the tech stocks. So in this final week of December, right, hopefully the consolidations have complete, and the Hang Seng could climb above this 26,500 point level to resume on the upside movement. So on the other hand, breaching on the 25,000 point definitely will dent the market sentiments, and we shall see more corrections on downside, especially on the next year. But so far, right, the Hang Seng are quite steady between this 25,000 point and 26,500 point level. So yesterday we do see a very strong rebound that led by the tech stocks, especially 20. The sense time 981 SMIC, right? In fact, the pop mark after underwent a very strong corrections recently. Yesterday also went up by around 4%, right? And of course, right now we are still waiting for more signal from Tencent 100, and also the Xiaomi 1810, right? Meanwhile, we do see a few counters in the Hong Kong market that stage of strong rebound, especially on the gold related counters in the Hong Kong market, right? And as for the futures, we take a look at the three futures report that we have. Firstly, the crude oil, right, WTI. So what we have known so far, right, that is the US starts to actually have a bomb on the Syria that targeting on the ISIS. Also, the US have actually circling the Venezuela, the sea line coastline, right, to block these sanctions oil tanker from moving the cargo out from Venezuela, right? That actually have both incidents have actually give some concern on the oil market, right? We do see that WTI yesterday have climbed above 58 US dollar. But so far I can see that for the past, I think at least 6 months, right, the crude oil has been actually moving downwards, right? All the three survey agency, the IEA from Europe, EIA from the US, and the OPEC from Middle East, three have actually see that next year in 2026, the oil market demand supply tends to be more balanced, right? Only the EIA and IEA are more bearish. They think that there will be a little bit of a surplus on the supply side. Meanwhile, the OPEC think that from a demand deficits, they actually tilted downwards to a more balanced market. All these have actually give rise to the cautious sentiment on the oil market. And we can see that the oil has been going downwards, right? And it has been moving steadily below the 50 and also the 200 days moving average. So in a very bearish setup, what we do see the opportunities is to actually when there's a rebound, right, technical rebound, that's where the bear will take opportunities to pound the commodities lower. So every high is opportunities to sell, and you can see that this WTI has been moving on a lower high and lower low. This is actually a very classic downtrend fashions. So recently it have actually moved above the 58, right? And so far we think that very strong resistance will be at 62 US dollar per barrel, right? Which is the high in the October, right? That's where the OPEC start to actually revise the outlook of 2026. Okay, so we have set our stop loss at 62 US dollar, right? So far we still keep bearish bias despite that WTI have a counter trend rebound yesterday night. Now, meanwhile, COMEX Gold has charged higher, moving upwards in tandem with their peers, silver. Right, silver has been actually moving upwards due to shortages of the inventory, right? And COMEX have experienced a very strong demand in the Asia market and also some of the BRICS countries. And the demand for the physical gold has been at a historical high level right now. And yesterday night, gold managed to break past this 4,004 level to this unprecedented level, right? So I think the gold will be moving higher towards 4,005 and followed by 4,007 in the coming days. Definitely with gold moving higher. Apart from the futures market, right? I think that the equities stocks that relate to the gold will also attract buying interest as well. So the downside support will be at 4,000 level. This is the round number, the psychological support for gold. So as long as gold stay above 4,000, right, it has more room on the upside so far. Now, meanwhile, the E-mini that track the Dow Jones in the US also actually moved up yesterday, right, eyeing to break past this 49,000 point level. So if breakout happen, right, then on the US Dow Jones will be trending into uncharted territory. So far, the technical setup remains bullish. So I think the sentiment have been quite strong recently. I think last week, 1 week ago, right, I have a discussion with two juniors, right. Both of them actually are telling me that the Japan, they are going to raise their interest rate. Market is going to have a knee-jerk reactions. But actually, I mentioned to them that when we look at the market, we must look for some of the evidence in the bond market. So right now, please allow me to share with you 2 minutes on how we see at the bond market, especially the interest rate directions. So firstly, you look at the Fed fund rate, right? What we have is understand the Fed guidance for the next year. But in fact, you look at the red color line, this is the Fed interest rate, right? Fed have actually cut interest rate 3 times this year, right? And Fed are using a band interest rate. So the red color is the higher band and green color is the lower band. Now, in fact, this is something mandatory that's set by the Fed that you can't change. It's not tradable. Now, what tradable is the gold color, the SOFR, and also the FF, which is the Fed Fund effective rate, right? So these are the two instruments that tradable, and these two instruments are trades by the major banks in the market that we call the overnight interest rate. So instead of using the old jargon overnight interbank rate, right? What they are using right now is SOFR, right? In the past, in October, we do see the SOFR actually went up a little bit. That actually impact the liquidity in the short-term market, especially the money market fund, right? But what we do see is that after the third round of the interest rate cut, the SOFR has been very quiet, staying below this rooftop of the red color. It shows that the market have ample liquidity. In fact, for the last 3 rounds of rate cuts, right, you can see that the DFF has been trending below the IRRB as well. So all these things actually tells that there will be a bit of tightness in the short-term overnight interest rate due to the some of the movement or rebalancing of the portfolio, all right, but overall that should not be a concern in the market. And we look at another uh, uh, higher time frame interest rate, which is doing a comparison between the 3 months, 10-year, 2-year, and 30-year bond yield. Right. What we do see right now is that you can see that this red color is the Fed interest rate. Right. So the Fed interest rate at about 3.75% right now is higher than the 3 months and the 2 years interest rate. In fact, you compare all the different bond yields in the US market, the cheapest right now is actually the 2-year interest rate. So you can borrow a 2-year bond, right, paying about 3.5% and using the proceed to invest in a 30-year bond, which actually collecting a coupon rate of about 4.83%. And that is actually the arbitrage opportunities that happens in the market right now. So you can see that in 2025, what happened is that the 30-year bond yield has been staying at a high level of about 4.83%, and the 2-year bond yield has been actually moving downwards. This is the sign that what makes the economists think that the economy have actually become strong, ample of liquidity in those. Prior than this, what we do see is that the short-term 2-year is much expensive than the long-term. It's very hard for the bond traders to do arbitraging. That's why the economy is not in a very good shape. But right now, since we are moved into 2025 and we are coming to the year end of 2025, right, the 2-year continue to actually move downwards and the 30-year stay over here, right, that shows that the market is confident that that the investors will actually do more investment on a long-term bond, which is a 30-year, and the short term is actually moving downwards. So all this shows that the economy is actually getting stronger and stronger. And right now, as we can see that based on this, right, the cheapest is actually 2-year, and all this shows market is actually in a very healthy situations right now. As such, right, I do think that based on all these levels, right, the equities market do have ample liquidity, and we should not be worried on the downside. Any opportunity or pullbacks that should be opportunities for us to ride on the uptrend. Now, you look at our Barnabas economics reports. He has been very bullish on 2026. In fact, his report title is the engine is going to in a full throttle right now in 2026. I think one of the key reasons is because of the this bond yield that actually traded by the bond trader that shows market have been very optimistic in the bond market. As the bond market is in an orderly fashions, right, equity market should see some of the support as well. Okay. Right, and as for the S&P, right, continue to move upwards. Hopefully, before we close for the year end, right, it can climb, stay above 6,008, and then looking forward in the January month or S&P to breach the 7,000 point level. Right, as for yesterday, right, the market continue to flow into a Tesla, as Tesla have actually become one of the darling of the market, that in 2026 market is actually looking forward for the IPO of their SpaceX, right? And yesterday night, we do see another space counter, which is the Rocket Lab, have actually went up by another 10%. It actually hit our R1 of 78 as of yesterday. Meanwhile, the AMD also have a gap up yesterday that actually closed above 215 right now. So among the chip counters, the front end semiconductor, I think that AMD is one of the attentions of the market so far. Okay, and FKLI, right, continue to move upward in this December month, which December seasonality is one of the most bullish months so far, and FKLI is keep steadily moving towards 1,007. Hopefully, before we close for the year end, FKLI can test the 1,007. So as for the FCPO, yesterday we do see that the surveyor, export surveyor, have published their first 20 days for export number, and the overall the month-on-month basis, the export number have actually improved, right? Instead of month-on-month lower, become a month-on-month higher. So we'll continue to monitor the development, but so far, 3009 has become the interim support for the FCPO, and from here, FCPO will be moving towards 4001, and it may test the 4180 as well. We set our stop loss at 4180, and we still hold on to our short positions, and in this week, FCPO likely to trade between 41 and 3009. Okay, and as for the trading stock this morning, firstly we'll be looking at Penta Master, then break past 3.90 cents, moving towards 4.10 cents, and followed by 4.30 cents. Downside support is at 3.70 cents. Secondly, we have KJTS that about to break past 1.35. If breakout happen, KJTS will be climbed towards 1.45 cents and followed by 1.55 cents. Downside support is at 1.25 cents. So we have a breakout stop, Penta, and followed by Penta KGTS pending breakout. Okay, I'll stop here and pass on to Sian on the Malaysia inflation report. Thank you.
Thanks, Joseph. So good morning, everyone. So I would like to give a brief update on the inflation data for the month of November, which was released on yesterday. So November CPI inflation actually came in still soft at 1.4% compared to October's print of 1.3%, which is lower than Bloomberg consensus, and also our in-house projection of 1.5% on year-on-year basis. So across the bucket, so we do see that the food and non-alcoholic beverage groups, which is also the largest component of the CPI, accounts for closely 30%, sustained a 1.5% year-on-year increase in November, so which is sustained at a similar rate when you compare to the previous month. So transport inflation continued to stay subdued and increased by 0.2% when compared to October's marginal decline of 0.1%. So due to the higher expenditure in public transport services and also purchase of vehicle subgroups for the month of November. So lastly, cost in the housing, water, electricity, and gas. So is to 0.7% in November compared to October's 1.1% growth. So driven by a decline in the electricity and gas subgroups following rebate for domestic users in Peninsular Malaysia, consuming over 600 kilowatt per hour. So looking ahead, so inflation in 2026 is projected to edge higher to 1.8%, so which is close to the upper end of the official 1.3 to 2% range. So this also reflects our positive outlook on the domestic demand, so underpinned by a steady investment, resilient consumption, and also expansionary fiscal measures. So despite this modest increase, when we compare to a projected inflation rate of 1.4% for 2025, so inflation is expected to remain manageable, so still below the long-term average of 2%, so supported by an orderly policy implementation and the absence of excessive demand pressures, as what we see now. So, and then for the next year, we think that the softer global commodity prices should also help to keep the domestic costs moderate as well. So overall, the impact of announced and upcoming policy reforms on inflation is likely to be contained, so supporting a steady monetary policy stance for the year ahead as well. So a few factors are expected to continue to drive the inflation in the upcoming years, so which including firstly, demand-led inflationary pressure, which may rise in next year due to a strong disposable income, so and consumption boosts the overall demand as well. So improved sentiment is expected from easing tariff risks and also a stronger economic prospect, along with enhanced consumer support measures, such as which will further support the domestic spending. So which including the higher direct cash aid. So a second round of 100 ringgit SARA payment for in February 2026, and also revision in the silver service salary scheme. So secondly, we're also likely to see some changes in the domestic policies. So, for example, the introduction of the carbon tax, which might have some pass-through effects. So, although the magnitude remain highly uncertain, given the lack of clarity on the tax rate and also sectorial coverage. And also, secondly, so recently, some announcement of the sin tax adjustment, so which including adjustment in the alcohol excise duty, and also cigarette excise tax, but this likely to be marginal due to the very relatively small combined CPI weight of this, which is roughly around 1.9% of the current CPI basket. And then beyond taxation, as what we see from news flow itself, the potential plan to extend subsidy rationalization to food items such as sugar, rice, and cooking oil might have some upward pressure to the food inflation, which food inflation actually accounts for 29% of the CPI basket. So the inflation spillover should be manageable if the recalibration is implemented gradually and in phases, as what we see in the diesel and also RON95 fuel subsidy targeting. And also, thirdly, adjustment in the RON95 prices where it was being lowered, and then which will actually continue to contribute to a softer transport inflation for next year due to a lower RON95 prices, and also there's absence of further tightening for higher income groups as well. So impact from electricity tariff restructuring as well, which do have a fluctuating impact on the inflation. So, and then lastly is a fluctuation in the global commodity prices, as what I mentioned earlier on. I think that's all from me. I will pass the line to the next presenter. Thank you.
Hi, thanks, Sian. Let me move on to sector note on energy. To recap our last quarter result, out of the 9 stocks under our coverage on energy, Redhill Utilities result came in ahead of our estimate, while TMB, Malakoff, and BM Green Debt fell short of projection. Therefore, we deem the sector earnings as below expectations given the result miss of TMB, which representing 50% of our sector coverage in terms of the market cap. To follow up some key updates on the sector, we see the TMB tax dispute overhang has been removed back in early July. We see that TMB recognized a one-off provision for 10 billion ringgit tax treatment in the balance sheet. Given the tax dispute has been resolved, this is positive as it removes any potential downside earnings given concern on the potential P&L impact in the past. Furthermore, the government also granted another approval for investment allowance to TMB to be deducted from their future income. And this is another positive news as it could potentially reduce the effective tax rate in the future. And we continue to like TMB for its stable regulated earnings, supporting their 4% dividend yield and further upside from reinvestment allowance recognition, reducing the ATI and last but not least, the upside from contingency capex approval. We believe the current share price, which is around 9.4 billion ringgit market cap reduction since the federal court ruling in early July, has been fully reflected the potential P&L impact from the IRB tax dispute, which has been removed. Hence, we believe it's a good opportunity to accumulate. And also, during the analyst briefing, TMB announced that it had secured letters of intent to extend more than 1,200 megawatt capacity supply from 3 gas power plants. Recall that the government had also called a tender to build new gas plants with a targeted commissioning by 2029, with the successful bidders to be potentially announced in the near future. Given TMB, Malakoff, and YTO Power's track record as gas plant owner or operators, we believe they are well positioned to secure these bids. And from the renewable energy side, we expect another growth year for solar, driven by higher EPCC contribution and the progressive ramp-up of recurring revenue from their CGPP assets, which is set to be commercialized by first quarter next year. If we refer to our budget 2026, we know that the government has indicated plans for LLS large-scale solar 6 tender with up to 2 gigawatt of capacity, and collectively LSS 5, 5 plus, and 6 could bring over 6 gigawatt of solar capacity to the market. In our view, this translates into a 18 billion ringgit worth of EPCC opportunities. And also, there's another interesting update for the sector is the rollout of solar ATAP. Recently, we see that Petra Malaysia has announced that the solar ATAP will be effective starting next year, with the guideline to be published by end of this month, replacing the net energy metering NEM scheme 3.0. In comparison to NEM, solar ATAP will not have a fixed quota at launch. However, we believe there's still the possibility for the government to impose a quota cap in the future to mitigate any integration risks that could destabilize the national grid. Hence, we believe this could unlock new revenue streams and broaden the private sector involvement, especially in residential solar projects. Overall, we expect this solar ATAP to sustain the solar adoption and drive further output replenishment for solar EPC players like SolarVest and Semaiden, supporting their growth beyond 2026. That's all from I think that's all from our team today. See you again. Happy trading and see you again tomorrow at Monica Pai.